So a couple of weeks ago, a student of mine sent me a screenshot of a trade. You can see it here on this screen, along with a short email, which I'll get into in a second. Now, before I sat down to record him a response, I had a thought. I bet there's a lot of traders out there who take a trade, it doesn't work out, and they have absolutely no idea why. And here's the thing, your best learning will never come from your winning trades. It always comes from the ones that fail. So that got me thinking, why not turn this into a weekly series where I take a real trade from a real student and break down exactly where it went wrong? So here we are. If you want me to review one of your trades right here on this channel, send me a screenshot of the trade and a brief email, just like this example here, to ali@marketmakertrading.com. My team will pick one at random, and as long as people actually want this type of content, of course, I'll do a review on it. If that sounds good to you, then let me know in the comments below. All right, let's get into it. First, let me obviously read out the email and let's dissect what actually went wrong here. Hi Ali, I hope you're well. So I'm not sure why I lost this trade. Was wondering if you could take a look and let me know where I went wrong. I saw a structure break, right? Okay, so here, and then price expanded higher after sweeping sell side liquidity. So I'm assuming this leg here rates sell side liquidity and then it expands higher. I was waiting for price to drop into discount and noticed that there was a small fair value gap near the 50 DRT level. Here's the 50 DRT level. Here's a small fair value. That's a very small fair value gap, right? I placed a buy limit here and my target was the buy side liquidity above. Okay, so he placed a buy limit at that fair value gap. I can see here he's put fair value gap in discount and he was targeting, I suppose, this buy side liquidity up here above this old high. And he placed his stop below the 25 DRT level. I like this stop because we have an immediate rebalance here. So generally, if price is going to trade through that immediate rebalance, it means it's going to go much lower. I was amazed to see how price reacted at that fair value gap. But before it could go to my target, it reversed and stopped me out. I don't understand why. Please can you shine a light on this for me? All right, so let's get onto a clean chart over here. I'm just going to move myself out of the way. Quick one. I've been working on something that I've never really done publicly before. On May the 18th, I'm running a 5-day live challenge called the High Probability Trading Challenge. Creative, I know. And I'm going to teach the exact process I use to look for any setup on any pair in any session and know it in under 5 minutes, whether it's worth my time or not. This is the same framework I've kept close to my chest for years and only ever really taught it inside of my private mentorship. On day one, I'm showing you why 80% of the order blocks and fair value gaps on your chart right now were never going to work and how to spot the difference. And once you can see which ones were never real, day 2 gives you the 3 condition checklist I run before I ever risk a single dollar. From there, day 3 is where we take that checklist and I show you how I find the single highest probability trade of the session in under 30 minutes. Then day 4. I'm going to read the tape live and you're going to see exactly how I apply everything in real time. In day 5, you're going to be building your own personal trading plan around your pairs, your session and your schedule. Now, tickets are capped because we're running this live on Zoom and Zoom does have a capacity limit, so it's a first come first served basis. Early bird tickets are live right now. Click the link in the description, grab yours before we hit capacity. Right, let's get back to it. So obviously we're on gold and this is on the 15-minute time frame, right? So essentially this was his trade. Placed a buy limit at that fair value gap and he was aiming for this high over here. Now it looks like he was in profit at first and then the trade went sideways and ended up stopping him out. So what happened, right? Technically, he wasn't wrong on this trade, and I'll explain why in a second. But first things first, the time at which he took this trade was 9:30 p.m. Eastern Standard Time. I don't know what his circumstances are in terms of why he elected to trade at this time of the day. Not my preference or my choice when it comes to trading this session, right? Essentially, we're in the Asian session. So between 8 p.m. and 12 a.m., this would be regarded as the Asian session. generally volatility here is going to be much lower and you're going to get more choppy sideways price action, which is generally what we tend to see inside of the Asian range. We call that the Asian range consolidation. And of course, we can use the Asian range for projections in terms of standard deviations for looking at targets, but again, beyond the scope of this. But the point here, when you're trading at a time of day where we shouldn't really anticipate large ranges, his initial target up here, based on where he was entering, was pretty far away relative to the range that price was trading in earlier. Now, the things that he did right in this trade essentially is he looked at the current dealing range, which was correct. That was from this low to this high. And equilibrium, or the 50 DRT level, was this red line. And he's seen that there was a fair value gap at that 50 DRT level. So again, high probability fair value gap because it nests at that 50 DRT level. Now again, everything that he did here was right. We can see the market moved away. Then it came back into the premium high of the fair value gap, overlapping with that 50 DRT level. And then it ran for the dealing range high. That would have been your trade. Again, his stop was placed correctly. He had it below the 25 DRT level and essentially the immediate rebalance here. But his target here was wrong. And if anything, he should have taken some partials above the dealing range high. You should never assume that price is going to continue to expand, especially when you're trading at this time of the day. So had he have taken profits above the dealing range high, which if you look closely, we had equal highs here as well. So that was a very good, strong draw on liquidity. And look at his drawdown here, was barely anything. So this is a typical example of a good trade, but being a bit too greedy and expecting too much at a time where volatility is very low in the market. So that's essentially the primary mistake here. Now, there are other things as well. Firstly, we can see that prior to his trade, we had the New York session between 7 p.m. and 10 p.m. Now, we had already raided the New York session high. The likelihood of this continuing higher, especially in the Asian range once we've raided the previous session liquidity pool, again, reduces the probability of an extended move. Secondly, if we take the entire dealing range, so from this high down to this low, we can clearly see that price was already in a premium where we had raided buy-side liquidity, and we also have this expansion leg here. Now, from this candle's low to this candle's high was a leg that raided buy-side liquidity to the left. And inside of that swing, what do we see? That's right, an inversion fair value gap. We respected it here. Look at the bodies. Was it showing any willingness to get through the consequent encroachment of that inversion fair value gap? No, right? The market runs higher, sweeps just above this high, taps a little deeper into the inversion fair value gap, and then you can see that we sell off. Not only that, look below the market. We have all of this sell side liquidity in the form of these relative equal lows. When order flow is already telling us that we're bearish, we've seen buy side raided and the smooth, clean areas are all sell side. Trading against this draw is a very bad idea, because ultimately the market is going to gravitate to where the most liquidity is going to sit. And here we can clearly see that that's going to be below these relative equal lows. Why is that? Because retail are going to look at this as strong support, like 1, 2, 3 times the market failed to get there. This expansion higher above the New York liquidity pool was them engineering sell stops below the market. Smart money here once, twice, utilizing that buy-side liquidity to pair short positions of their own, and then the market distributes that lower back to those sell stops. So you have to understand what market narrative is doing. What has the market previously done, and where is it likely to reach next? And then we can also assess algorithmic order flow in terms of what a raise in price is either supporting or repelling price. Now we can clearly see here, inside of the range of that inversion fair value gap, we have this breaker from this high down to this low. So these consecutive down close candles overlaps with the inversion fair value gap. Now look at the mean threshold of that breaker. Is the market here showing a willingness to get above the mean threshold of the breaker? No, right? We're seeing it wick through it, but look where the bodies are closing. Now, this is just on the 15-minute time frame. We can see all of this information. Now, let's jump to a higher time frame. So let's go to an hourly time frame. We can see that this candle here, we had wicked through the previous high up here. So we'd swept above it, but where did the candles close? Back below. Again, that signifies that the market isn't yet ready to leave the dealing range, and it retraces back into it. We also have this rejection block. Now, at the time of the trade, we were again noticing the bodies fail to close above the rejection block, which also overlapped with that 15-minute breaker. So even if you're offside, all of these things should be warning signs to essentially get out of the trade and that you probably are offside, because algorithmic order flow is telling you with that higher time frame to lower time frame price delivery continuum that you are likely offside here. So the market is, instead of going higher, likely to reprice lower to the sell side liquidity. And again, on this hourly time frame, we can see the remainder of this hourly buy side imbalance, which rests where? Below those relative equal lows. Now, when we have a situation where both liquidity and an inefficiency are nested in the same area, that's going to be a very powerful draw on liquidity, and subsequently we can see the market turned around here and then really ran for the stops below those lows and balance the remainder of this inefficiency. So I hope this clears things up a little bit. If you like this type of content, if it's useful, I don't know. Let me know your thoughts in the comments. And again, if you want me to review one of your actual trades, then send me a screenshot and a short email briefly describing why you took the trade, and who knows, maybe it could be your trade being featured on next week's episode. Thanks for tuning in. I'll see you in the next one.